Hello, everybody, and welcome to our CEPR SAFE policy webinar. My name's Tim Phillips, and I will be moderating today when we are talking about how we tackle a wave of non-performing loans after COVID-19. Well, we can pretty well assume that as the COVID-19 support measures unwind, European banks will likely have a wave of non-performing loans. So what are we going to do about it? Well, the European Commission has an NPL action plan, and a lot of other people are also giving their advice as well. And we have some of them speaking on the webinar today. So who do we have for you today? Well, you would think if you were going to be talking about a subject like this, the best person to have would be maybe the chair of the ECB Supervisory Board. Well, we've got him for you. Andrea, welcome to our webinar.
Hello, hi. Very glad to be here. Hi, good afternoon.
And Andrea is going to be starting us off in a moment and presenting for us, but I'll also introduce our two other guests before we go to Andrea's presentation. Also speaking today will be from the Leibniz Institute for Financial Research, SAFE and CEPR, Loriana Pellizzon. Loriana, great to see you again.
Good afternoon to everybody.
And also the director of the Florence School of Banking and professor of banking and finance for the business school at the University of London for a limited engagement only, and the CEPR, hopefully forever, Thorsten Beck. Thorsten, great to have you.
Thank you. Thanks for having me. Glad to be here.
Yeah. Now, and also very importantly on our webinar this afternoon, all of you who've come along to listen to this. It's great if you take part, though. We have a really big audience today, and I'm hoping that a lot of you are going to have questions. To ask your questions today, the Q&A tab at the bottom of the window here, you use that. So type in your question. I have two pieces of advice about this. The first one is to not wait too long to ask your questions. On our SAFE webinars before, we have always had some great questions and plenty of them. But unfortunately, some really good ones come in 5 minutes before the end, and we're restricted to 60 minutes today. We will not be going over. So if your question comes in at that time, well, I'm not going to be able to see it. The second thing is, even if you don't want to ask a question, have a look at that tab from time to time, and you are able to upvote the questions that you think are the most interesting. And so that means that when I come to look at it, those questions are near at the top and they're more likely to be asked. So as I said, we only have 60 minutes. Our format today will be Andrea will present first of all, then we will have remarks from Loriana, then we'll have remarks from Thorsten, and then we will discuss the points that you raise. So first of all, I would like to hand over to Andrea, who will be talking about non-performing loans. Well, Andrea, this is I see from the media, this is a subject that you're asked quite a lot about these days. So over to you.
Okay, thank you. Thank you very much, Tim. And let me see if I managed to share my screen. Okay, so let me start let me start with the backward-looking perspective. So what has happened so far in terms of non-performing loans? And the short answer is not much, actually. Actually, it has happened that non-performing loans have continued decreasing. We have had basically a decreasing trend that has continued since the establishment of the banking union. This has continued also during 2020, during the pandemic, and we have not yet seen any significant materialization of credit risk from the recession of last year in the banks' balance sheets. In terms of going a bit deeper on this, let's say if we focus, if you zoom on what we call the high non-performing loans banks, the high NPL banks, so those for which we have a specific process asking them to declare targets for reduction of NPLs and to meet them ideally. Well, the good news is that also in those cases, banks have actually met their targets, and even in 2020, so there has been a continued reduction process. and that there has been a good quality of the adjustment. So this is not shown in the slide, but basically if you go down to the type of NPLs which have been addressed, it's mostly long-dated NPLs. So it's the most difficult ones to deal with, the ones which are, let's say, stuck in the balance sheet since a long while. So it's not just taking the easiest part of the NPL. And the main driver of the adjustments has been through sales and securitizations, basically, which is also good in a year in which, of course, there has been a lot of turmoil. And on the right-hand side of the slide, you see that basically the public support schemes, so public support guarantees to securitizations like GACS in Italy or HAPS in Greece, and asset management companies have played an important role in supporting this continued process of reduction. Now, let's start taking a more forward-looking perspective. If you browse through analyst reports more recently, I took Autonomous as an example with their, let's say, authorization to use their quotes. Basically, there seems to be a pretty rosy, pretty positive outlook on analyst side. So what they say basically is that all banks are reducing provisions, and that most have barely started to reverse the precautionary stage 1 and stage 2 reserves, and they believe that this would create potential for further decrease and higher profits in 21 and 2022. So basically, they argue that all the credit risk indicators are turning more positive, and there will be a release in provisions that will translate into higher, payouts, dividends, share buybacks, and this is also driven, as you can see in the top right part of the chart, a positive momentum in stock prices. If you look at the projections that the banks give us, I mean, they totally match this narrative. So basically, banks are expecting a recovery in profitability, which is driven by basically a slight increase in revenues with the fee income basically compensating the decrease in net interest income. Administrative costs basically increasing a bit. What is really driving the improvement is falling loan loss provision. So credit risk seems to be going downward in all the projections. So of course, when we start looking at the issue from the supervisory perspective, from our perspective, then we are a little bit, trying to put some words of caution in this relatively rosy narrative. And I will try to run you through the main areas of concerns that we have currently. I mean, first of all, of course, there are still a lot of borrowers' relief measures in place. We have still a lot of moratoria, a lot of government guaranteed loans which are which are in place, and it's clear that from the analysis we are doing, some of the traditional credit risk management practices do not seem to cover in a very appropriate way this type of loans. Of course, the moratoria create a sort of blind spot in terms of payments. The guarantees, of course, might create relatively warped incentives for banks, and we still cannot rule out some cliff edge effects once the public support is phased out. And we are particularly now going more granular in our credit risk analysis. We have issued last year 2 Dear CEO letters in which we identified some concerns that we had, seeing very diversified practices at banks, and we are drilling down now as a follow-up to those letters, and especially also on some sectors which have been hardly hit by the crisis. And what we see is that if you look at the indicators, of course, in terms of asset quality, if you take the loans which are emerging from moratoria and other forbearance measures, they already perform slightly worse than the other loans. and especially they have a much lower level of provisioning coverage. So there seems to be, some risk which is not assessed properly there. Still, let's say the increase is still, we have to acknowledge, rather moderate. So even the exit from the moratoria has not been associated to a massive, let's say, suspension of payments and transition into non-performing loan status. But it is true that we still have a lot of other public support measures directly oriented to the borrowers, such as furlough schemes or other tax relief or direct grants to certain sectors. So there could be also a number of risk shifting, let's say, incentives at play, and we need to look into that more deeply. In the specific focus on the food and accommodation services sectors, we have seen very low share of loans which have been reclassified as forborne, even though modifications were granted. We have seen insufficient assessment whether a loan is unlikely to pay. We have seen reduction in the probabilities of default of new loans. I will come back to that in a second. In many cases, banks are using still ineffective backward-looking indicators, which are unable to anticipate the deterioration in asset quality, and this might delay proactive engagement with distressed customers, which eventually could transpose after a while into higher non-performing loans. So that's a little bit a major concern that we have looking at these type of loans. There are indeed quite a lot of exposures to sectors which have been hit hard by the crisis. And on the right-hand side, there is something which is a bit of a puzzle for us at the moment. We are seeing, this is what is shown here is some banks, the probabilities of default before and after, let's say, the March last year. And the same type of dynamics you can identify, and this is on the accommodation and food services sector, but the same dynamics we find in the residential real estate and retail exposures. And what we see is that PDs, probabilities of default, are actually decreasing, which is actually the opposite of what you would expect, right? I mean, if you have public guarantees, you would like to see, you expect to see loss given defaults, LGD parameters to decrease, but the PDs should not be directly affected, although I understand sometimes the issues are not so simple. But seeing that in a moment of such an increase in the risk environment, the probabilities of default are decreasing, in some cases materially, and for a wide number of banks is something of a puzzle for us, on which we are drilling down further. The other point is that there is a wide variety of practices, both in terms of classification of loans, in terms of provisioning decisions. There is an increase in the loans which are assessed at stage 2, so for a significant increase in credit risk, but honestly, you find a very wide variety of behavior. And what you also see is that stage 2 loans, the reclassification to stage 2 has actually reduced in many cases between the first quarter and the second part of the year. So it means that basically banks have turned more positive towards the end of last year, while the second wave of the pandemic was materializing. And we also see a lot of direct transition from stage 1 to stage 3. So from loans which are fully performing to loans which are reclassified as non-performing. So this seems to indicate wait-and-see practices. Now, that banks do not reclassify loans until actually they are totally sour. Now, finally, macro outlook and bankruptcies. Here, let's say, if you look at the macroeconomic forecasts, they've generally moved in more positive territory since the middle of last year. Both the the baseline scenario, that the severe scenario. Let's say the baseline scenario has improved gradually, and the adverse scenario has come closer to the baseline scenario. So the overall outlook, also stressed outlooks, are improving, which makes the estimates of non-performing loans that we published summer last year a bit outdated. Still, let's say we are, a little bit puzzled on what we see. In a sense, if you look at the provisioning behavior, we see a reduction in provisions, not yet a release of provisions. US banks have started already releasing provision, not yet for EU banks. But still, if you look at the behavior of banks in past recessions, usually you start seeing a reduction in provisioning when you are close to the peak in the bankruptcies. And if you look at the indicator of bankruptcies, the second chart, I know that Thorsten will go back to the issue, we have actually experienced a decrease in bankruptcies in this first phase of the crisis. So if there are more bankruptcies to come and to materialize, then we might see that maybe these reduction in provisions have been a bit premature. Also, another important point, I mean, the ECB in the Financial Stability Review said so this morning, the recovery is expected to be rather strong, but is also expected to be uneven. So there is going to be a lot of differences across sectors, lines of businesses. So there are going to be casualties. So expect in any case the asset quality to deteriorate. Now, if we consider an adverse scenario in which we have a significant materialization of non-performing loans, do we have the tools to deal with that? My impression is that we do have improved quite a lot our toolbox. The calendar provision is now in legislation. We developed guidance on how to deal with non-performing loans, which has been pretty effective. The Commission put out this communication in December last year with good proposals on the secondary market for NPLs, on the possible use of precautionary capitalization and networks of asset management companies to deal with the problem. However, let's say I'm still not entirely sure that we have the sufficient, if the hit is going to be big, let's say, I'm not sure we are sufficiently strong to deal with it. I hope we don't get there. At the moment, there is no expectation we will get to a very significant hit, but I remain convinced that, for instance, we look at the vulnerability analysis we ran last year, only a handful of banks would have been able to benefit of precautionary recap, would have been eligible for precautionary recap, and so to possibly use the support of asset management companies according to the Commission's let's say, blueprint. So maybe if we were to get there, we will have to rethink a little bit on the toolbox and see whether we need to strengthen here and there. I hope we don't get there, of course, but I think we need to also be prepared to the worst. So in conclusion, and here is really the end, macro outlook sensibly improved, uncertainty is getting lower. There is a positive market momentum. Banks have also continued lending, which has been positive. So there has been no knee-jerk reaction to the crisis in terms of reducing lending. So that has been very positive. But again, from the supervisory side and the granular work we're doing, there are still a number of areas of concerns that would suggest that banks strengthen their crisis management standards and try to capture the specifics of these rather unusual crises. Thank you very much.
Thanks very much, Andrea, and a much more positive outlook than we could have expected even a few months ago. But can I just get a clarification from you on something? I think it's a couple of weeks ago. I think I read I think it was a Reuters report that you were saying that 40% of Euro area banks were falling short in their preparations to deal with non-performing loans. Is that correct?
Yeah, that's exactly right. What we said is that there are a number of banks, around 40% of the banks, for which we have identified issues in their credit risk practices, credit risk management practice. So we are going back to them and asking to, to rectify areas in which we have seen shortcomings. And I mean, this is not necessarily, covers a wide range of findings. So from, relatively minor findings to serious concerns. So it's not really, sometimes, I think that the way in which it was characterized in the press was 2 out of 5 banks sweeping the dirt under the carpet. That is a little bit of a journalistic exaggeration. But yes, indeed, there are several banks with which we are not entirely satisfied in terms of credit risk management practices, indeed.
Mm-hmm. And so the 40% is kind of that sort of, that doesn't worry you. The number in itself doesn't worry you. That's kind of like as you say, that's in the reporting.
It's a signal that we are not entirely satisfied of the way in which banks are managing credit risk in this specific crisis, and that we are expecting more of them, and we push them to do more.
Right. Well, I suppose if you were entirely satisfied, then you wouldn't have anything to do, and I don't think that's going to be the case anytime soon. Thank you very much. Loriana, I'd like to ask you now to respond to what Andrea said, and also to talk a little bit about the research, the white paper that you've written about NPLs.
Yes, so thank you very much for giving me, and actually, I'm representing several other authors of this document that we produced for the government support unit of the European Commission. And the title of the topic that we addressed, it was non-performing loans, new risk and policies. And we pretty much analyze as external how let's say large will be the impact on non-performing loans due to the COVID crisis for banks. And actually the number that we predict are quite in line with the one that Andrea and Enria just presented. Well, this time the crisis is quite different than in the past. Banks are more prepared, so at the end, they have more capital, and on the other side, the fiscal support clearly prevent them to have a huge wave of non-performing loans so far. But even if this crisis is different, and so far we didn't see too much in terms of non-performing loans, there are 5 important questions that we learned from the previous crisis that we need to keep in mind, because a non-performing loans is a non-performing loans independently on how it has been generated. And this means that given also the significant heterogeneity that this crisis is going to generate in the portfolio of the banks, it largely depends on what are the type of sector that the banks are largely supporting. We know that this crisis is not affecting all the sectors in the same way. So clearly, even banks will be not affected in the same ways. And there is a lot of heterogeneities across banks. And also, as the banks enter into this crisis, it is quite different. But if you're looking pretty much to the 5 main lessons that we learned about how to handle non-performing loans in the past, is that the main important thing is that non-performing loans, if they are not identified and recognized in an efficient way and in a fast way, then this will have a significant impact in 2, 3, 4, 5 years after on the GDP growth. So this is really something that we need to keep in mind all the time that we are trying to address the issue regarding non-performing loans, because the pattern is quite clear. If you're not addressing it on time, this will create zombie lending, and then not only you will have zombie firms, but you will have also zombie banks. And this will have perverse effect later on, because zombie banks are not able to support the economy anymore. So this means that we need to intervene, and the pressure that it has been already demonstrated by Andrea and Enria on checking what are the practices that banks are adopting is already in the direction of the second lesson that we learned from the previous crisis, that in most of the cases, banks do not have the right incentives, to implement early effective non-performing loans identification, because this is obvious. This means that they need to show that their capital buffer maybe is not enough, and so on. So they do have the incentive from their individual perspective to postpone, let's say, the identification of non-performing loans, also because maybe, you're always hoping for the best, that as soon as is only a probability of default, but not an actual default, maybe it's not going to materialize. So this is why regulators, and this is the third lesson, has really to intervene and ex ante provide the incentives to banks to recognize non-performing loans. How they can do this? Via the asset quality review, via the stress test, via adequate accounting rules. So in this way, we will see that this is what we empirically evidence in the past, that realistic loan value assessment are going to incentivize banks to recognize non-performing loans early and to handle them efficiently, for example, selling them in a secondary market for non-performing loans. The solution instead that in the past has been adopted several times because, non-performing loans has not been identified early on time and managed early on time. It was forbearance or public bank recapitalization. Clearly, we do observe during this crisis a significant intervention from the public point of view. And we are listening in several, let's say, from several parts that they're saying, well, the governments all around Europe and actually all around the world, it has helped a lot firms and householders. Why not banks? This is a typical question that, we are continuing to listen. And the problem is that we know from the past experience that forbearance or public bank recapitalization is ex ante and also then ex post, providing adverse incentive to banks that will generate, as I just stressed from the first lesson, zombie firms and zombie lending. So clearly, we need to be very careful on how we are providing the incentive to banks to recognize on time and to get the right incentive to recapitalize, potentially without the use of public bank recapitalization. And then we have the fifth lesson that is coming from the past, that, in Europe, we do not have so far a well-developed secondary market for non-performing loans. There is some improvement even during the 2020, as Enria has, in a sense, stressed, the use of, on one side, Hercules or gaps that help, in some sense, the securitization, maybe with some support from the public side, was going on this direction. But we are not really at the point where we can claim that banks do have the incentive to, in some sense, recognize the loans that are non-performing and selling them in the secondary market, because there is a huge gap between the price that banks are willing to sell the loan and the price that the market will be willing to buy the loans. And because of this huge gap, that it is due to several reasons. One is information.
I think we've lost Loriana for a second there. Let me just, if we just wait for a second to see if she comes back. And if we just give it a few seconds, but if not, then we will move on to you, Thorsten. Yeah, I think luckily we were at 0.4.5 out of 5. So it's a shame that we didn't get right to the end of that. But Loriana, if you can hear us, then it's probably best if you reconnect. If you can't hear us, I assume that you're going to do that any second now anyway. So we move on. Thorsten, I hope you have better luck in getting to the end. I'm interested in what you have to say about what we should be doing about non-performing loans.
Well, thank you very much, Tim. So I actually kind of want to follow up on what Loriana said, but maybe first take a step back and look at a little bit of the bigger picture. So what ultimately we're facing is a trade-off between protecting the economy, protecting the society during the crisis, and on the other hand, kind of going back to normality in the sense of letting the market allow to work properly. And of course, so initially, there were lots of support measures. We had the fiscal support measures, loan guarantees, monetary policy, capital relief, and so on. So now the big question that comes up, of course, is how do we get from the current situation of all of these support measures back to kind of a normal functioning financial system? And obviously, as long as the pandemic is still around, that will be very hard to do because a functioning financial system kind of relates to a functioning market economy. And as long as the markets don't work properly, we can't really rely on that either. So the point, the first point I want to make is that I find it very striking, actually, what Andrea mentioned, that these optimism of some analysts and then the more conservative approach, actually both by the SSM, but also by Loriana, and actually I kind of share this, I'm not sure whether they call it pessimism or realism, but the question is really where does this come from? But maybe one of the solutions is to say, well, the losses that will ultimately incurred are endogenous, in the sense they are endogenous to the policy choices that are being taken. And that, of course, comes directly back to the lessons that Loriana just mentioned. And I let her finish later on for the fifth one. Number one is, and so coming back to the exit from the support, the phasing out, and Andrea also mentioned the cliff edge. That, I think, will require a lot of cooperation, coordination across of lots of different policy fields. So, for example, if the moratoria on loan payments are gone, then, of course, this might have reactions in the banking system and in terms of the non-performing loans. If the guarantees are kind of phased out, then you might have a situation where lots of corporates are getting under pressure. If you go back to regulatory requirement, for example, IFRS 9, then of course this might have implication for banks' balance sheets. So the issue is not only just about the losses that will be there, but of course also kind of get to a process that these losses are being recognized quickly, as Loriana pointed out, but then also being handled in the most efficient way. So setting the incentives, and kind of this was also a question actually in the chat, which the Q&A box, which Loriana partly answered. We cannot rely completely on the market, kind of banks selling non-performing loans, hedge funds buying them, but we need both the incentives to kind of convince banks to actually sell them, but then also, of course, giving them the tools so they don't have to sell them at completely depressed price, which then, of course, in turn would then put the bank's balance sheet under pressure and ultimately result in lots of bank failures. So there is kind of a very visible hand actually needed of the supervisory authorities. Now, that gets me to the next point. So again, the coordination issue. If it's true that there will be an increase in corporate insolvency, and we had this ESRB report coming out a couple of weeks ago that actually points to a likelihood there will be quite some corporate insolvency concentrated in certain sectors and maybe in certain countries, that will, for example, can overwhelm the insolvency regimes, the insolvency frameworks, the court systems in some country. What is going to be done about this? At the same time, you have, of course, if these non-performing loans or these corporate indebtedness turns into non-performing assets on banks' balance sheet, this again might turn into bank fragility, which then affects, of course, the Bank Resolution Authority. So I think this kind of the exit strategy, the phase out, I think that will be the critical point, which ultimately determines whether even like an initial rapid recovery will ultimately be kind of a long-term sustained recovery, or will be kind of cut short. And I guess in the worst case scenario, and I don't want to predict that, but in the worst case scenario, kind of lead to a replay of what we had 3-4 years after the global financial crisis in the euro area, which we definitely nobody wants. So maybe a last point I want to make here is that there is, of course, a lot of variation across Europe. So I just came from another webinar where I was told that there won't be any NPL problems in the Netherlands, for example. They're doing all fine. Why? Well, the banks are all giving just no mortgages. And the economy is doing okay, and the mortgages typically in the Netherlands, you don't default on a mortgage because it's really, really bad for you personally. So the Dutch banks might actually be in a good shape. Of course, the business model is a bit outdated and they are under cost pressure. But there might, of course, be other countries in the Euro area, in the European Union, who come under much more pressure. So I guess the concern that I would raise is that you have a concentrated problem sectorally, but also in terms of countries. And of course, we have a bank resolution framework in place, the BRRD, with national insolvency, national bank resolution regimes, and so on. But is that really fit for purpose when it comes to a more widespread bank fragility, especially on specific in specific countries? And now, related to that, and coming back to the issue of what to do with non-performing loans and the kind of the sale of these loans. I mean, so there is the idea now, and that has been raised, for example, in the paper by the European Commission, of having national AMCs, maybe linking these national AMCs. The big question in the room for me is, can we really do this all on the national level? Or is there, like we had with the recovery plan or the next generation EU, is there also a necessity to not just coordinate these responses across countries of the EU, but maybe also the funding across the EU? Can we really go away and kind of, I guess the worst case scenario is again that we have different uneven responses to bank fragility, which then again would exactly do what Loriana pointed to, that the ball is being kicked down the road, the can is being kicked down the road, and you lead to zombie lending, and that kind of leads to this K-shaped recovery that many people are afraid of.
Thanks very much, Thorsten. Loriana, we're delighted to have you back. We were worried that you wouldn't come back.
Sorry, but there is a thunderstorm outside, so my connection is having problem. I think that the fifth lesson, in some sense, has been already stressed by Thorsten, the fact that you need really to find incentives for both part of the traders in the non-performing loans market to trade. So on one side, for the banks to sell and for the buyer to buy. And one incentive is to provide them the right information, so try to reduce the asymmetry of information. And on the other side is really to provide the incentive to recognize the true value of the non-performing loans. And if I might, but maybe I see a lot of questions going back to the AMC. We have a general question on our document we provide to the European Commission is. Why do we need an AMC if the market should be the one that do we need a public AMC, or maybe just a classical, let's say, investor institution that is then handling this non-performing loan? So, and this clearly then is going to touch all the different dimensions of having it at the national level, at the European level, and who is making the money at the end on this type of let's say, support.
Okay, thank you. That is a very good place to finish, because if you look on the Q&A tab, the question that has the most support at the moment from Horst is saying by persuading banks to sell their NPLs, are we not to some degree weakening the banks further and subsidizing hedge funds, because banks are becoming forced sellers of NPLs? Loriana, is that part of what you're talking about here?
No, we are not talking about this, of course. So our point is that what we need to force is that banks are evaluating their non-performing loans at the most fair value. That should be related to the fundamentals. And they have actually this type of information. And I think that it has been stressed already on this, let's say, rule that the supervisor is implementing on managing credit risk, on pushing on, the different steps on which you are going to investigate the level of risk of your loans are all going in the right direction. And if banks are doing this, then, they will just report in their balance sheet the fair value of the non-performing loans. And they will be not forced to sell these non-performing loans at the very low price, as soon as we will have, indeed, a secondary market where the asymmetry of information will be reduced.
Mm-hmm. Andrea, your opinion on this?
Well, I mean, first of all, let me say that we should not underestimate the effect of the new policies on NPLs, which have been approved by the ECB first and then also by the legislator after the last crisis. So basically, a strong incentive which is given to banks now is that there is a sort of calendar to write off the loan. So if a loan turns non-performing, if it is a non-guaranteed loan, after 2-3 years, you should have it totally written off. So basically, this sort of disincentive, because the banks want to keep the loan at a reasonably high price, goes away. So this is, I think, an important change that will change the incentives of the banks quite radically. Second, of course, there is the supervisory pressure, which we try to exercise with a good deal of energy. And third, let's say that there could be, however, I mean, this is, I don't know, a topic on which I would like also to hear other views. I mean, I remain convinced that asset management companies could have a value. First of all, because, you know, there are, in many cases, I mean, we still have a banking sector which is very fragmented. We always look at the large banks, but in a number of cases, we have a plethora of very small banks which go underwater very easily with asset quality problems. And for them, it might not be that easy, you know, to sell a non-performing loans, to securitize a non-performing loan, which requires quite a lot of, you know, expertise. So there is a little bit of a need for a mass, you know, to manage actively and these loans. So in my view, that this is a first argument that militate in favor of having asset management companies that could be public, could also be mixed, private, public. NAMA, for instance, in Ireland, also SARB in Spain have been mixed private-public initiatives. And the second point is time. No, I mean, sometimes when you have very depressed market value during a squeeze, during a big and a lot of you know, risk aversion, which is spreading across investors, the markets could be very depressed. And if you have somebody who has the muscle to wait a little bit, maybe the final realization value, which is a little bit what Loriana was mentioning, where do you put eventually the profits, let's say, of the management of these assets? If you don't want to distribute all to the investors, but maybe keep something for, you know, either the banks if they participate or the public sector if it supports, maybe having an asset management company is useful. And finally, on the point that also Thorsten was raising, I mean, I've been raising in the past several times the proposal of having a European asset management company. Everybody's been telling me, no, that's impossible. The assets are too heterogeneous. You cannot do that. Actually, if you look at the way in which private investors manage their distressed assets in Europe, they treat Europe as a single jurisdiction. They manage them from one, they service it with one servicer, usually located in London. So I don't see why you couldn't do it the same. But anyway, if you want to go through national channels, I think that would be very good to have at least the pricing and funding aligned at the European level, because otherwise you would have a massive unlevel playing field between a bank in Greece that would have the funding condition of the Greek Republic, basically, and a bank in Finland that would have the funding conditions of the Finnish government. So that's something that, for me, for the integrity of the banking union, is a very important point.
Thank you. And Thorsten, I'd like to get your response to that, but also I see your name mentioned in the questions here. Patrick Honohan, a man who has some experience of these issues, I think, Patrick. And he's asking that he's saying quick action to deal with distressed borrowers. Yes, to avoid zombification. Yes, he supports that. But how quick? How quick should it be?
Yes, well, thank you. Yes, so of course, Patrick has the experience, but not only actually of Ireland, but also before that, actually, from the emerging world. And I've learned a lot from him, actually, in terms of crisis resolution. So I think I can't really give an answer to that, But what I know, again, what I want to say is that these two things have to be coordinated. The things in terms of forcing banks to recognize, to classify properly the loans while being ready to intervene banks if it is necessary. Okay, so that the kind of being prepared, the moment that banks basically have to kind of show their cards. And of course, one critical moment is, it's kind of ongoing right now, which are the EBA/SSM stress tests, which probably will give a first picture in terms of how asset quality looks, at least across the significant institutions within the euro area and the EU. And building on that, basically to plan ahead for what might have to be done. And of course, at the same time, even independent of the stress test, and I think some of the work is probably ongoing, is to kind of get a clearer picture of the loans that are currently under moratorium. And I think actually Andrea referred to this, and there is work at the EBA and the SSM, like how many of these loans will become non-performing when it is the moratorium will expire. Of the guaranteed loans, how many corporates are actually over indebted and then might get into trouble once these guarantees expire. So I think that kind of work has to be done now. And of course, then again, standing ready the moment that the banks are being forced, are being, so to say, incentivized to actually show these losses. That's also the moment when it has to be the regulatory authorities have to stand ready. Maybe as a second remark here, and actually, sorry, there was another comment here which I kind of briefly want to refer to by I can't say the name. Yeah, Caroline Metz. So I think there's a very important issue here actually. And I mean, one thing is the real estate loans, and again, especially here, of course, the time value might be very important. But of course, when it comes to small business loans, there the personal contact between the, let's say, the branch manager or the loan officer might actually be very important. But there are ways to work around this, right? There is the value, for example, in the AMC, but the loan handling management still in the bank. So there are solutions where you can combine these two and still provide incentives for the banks to recover it as much as possible, while at the same time helping them to offload the assets. So there are kind of ways around that. And then my last point I want to make, and I'm delighted, I kind of knew this beforehand, of course, that Andrea is also a big fan of a European level AMC, and I think we really need that, especially because, as he said, the uneven playing field would really risks repeating the mistakes that were made 10 years ago after the global financial crisis and during the Euro debt crisis. And I think that we should definitely learn from.
Thank you very much. Loriana, can I get a quick comment from you? As Thorsten says,
yes,
it's clear that we don't know very much about loans when the moratoria, but I want you to specifically, can you talk to me a little bit about how deep the transparency should go? Should it be loans or portfolios?
Yeah, so one thing that we are stressing is that the transparency should go at the level of the loans, because if we really want that this asymmetry of information will be reduced, then, you know, having information about the probability of default of the portfolio or the distribution, where it is not clear really what are the drivers and how it has been calculated, this will create still asymmetry of information. So this is one point that we are making in the paper. But I want to add a little bit on the reason why it can be useful to have, let's say, a mix or maybe between AMC that is public and private. And one of the reasons is these small banks that I do believe that we need to think, and they are playing an important role in Europe. But on the other side, I wonder how we are bringing into the picture the problem that in Europe we have, in some sense, overbanking. At least this is what we are continuing to propose under several dimensions. So it should be clear that small banks, they are playing an important role at the territorial level. So I'm not saying anything about small banks or large banks, but in Europe, and more given the trend of the fact that this crisis has changed the way in which banks has been done. You know, we have a technological change as well, so the business model of the banks has to change. So the question is, do we really not just try to preserve the status quo of the banking sector, and all the time that there is some problem, we are intervening either with the MC that is having private and public support or something like this? Or are we instead really thinking that given that the world is changing, even the way in which we are looking to the banking sector is changing, and we need to seriously consider how we are also handling, together with the crisis, also maybe the presence of overbanking. And on the other side, I understand that there is a lot of market failure. You know, it's not easy to sell this type of asset that are highly asymmetry. If you have a lot of asymmetry of information, you have different players, you have the collateral that is having a value per se, and you have the borrower that clearly is having his own rights. So it's not an easy task. But thinking that only the public support is a long-term investor, and instead we need to think that there are a lot of other private players that are long-term investors in the market, and maybe we need to think on how to evolve them, can be also another solution for the fact that maybe, you know, the shock is too fast and we cannot then just leave the market to solve the problem now. But we need seriously to figure out who are then the patient investors that can help us to go out from eventually this type of situation.
Thank you. There's a question, popular question from Nicholas here about whether we should be looking at suitable instruments to strengthen the regulatory toolbox to resolve this, specifically to resolve this problem, and looking at such things as insolvency, contract enforcement frameworks that are beyond the influence of bank supervisors. So yes, stronger regulatory frameworks. Thorsten?
Yes, of course, I agree with that. However, I don't think there will be time to kind of reform corporate insolvency laws in time for possible corporate over-indebtedness, for possible necessary corporate restructuring across Europe. It's, I mean, also from my own experience, again, in countries who want to reform such frameworks, there are lots of political interests here, and they cannot be changed so quickly. So I think what we have to probably think more about for the short term is kind of some kind of expedited, extraordinary restructuring mechanism that can be put into place specifically for the current crisis. And probably again, with the banks being in a very kind of central core positions, because they are probably the main creditor to many of these companies.
Andrea, what's your opinion on this?
There is no, I mean, if you look at the areas where you had a high concentration of non-performing loans issues in the last crisis, you always had a problem in terms of judicial procedures not working properly. And one of the original, let's say, recommendations in the NPL roadmaps that was issued by the Council, if I remember well, in 2016, 17, I can't remember now the date, was exactly to strengthen the judicial procedures. And again, I live in a world of second best, to say the least here. I mean, I don't have the ambition anymore to have harmonization of procedures here, but at least having improvements, that's something that we could expect. And indeed, we are seeing positive steps. I mean, the progress in Greece. In Greece, there has been a new insolvency law passed by the parliament a few months ago. And this is strongly linked also to the progress in terms of pricing, also of the loans that the Greek banks are selling. So you see immediately the benefits. So I think that this is an area in which governments should really think ahead and see whether they can improve the framework. The sooner the better, irrespective of whether there will be a huge materialization of NPLs. This will be good in any case going forward. And if you allow me on the point of Floriana, again, I think that indeed the key point is making sure that whatever tool we use to deal with the crisis this time, we also have a proper mechanism for prompt restructuring of banks. I think that indeed the problem in the past was that in some cases, if you compare the EU with the US, you didn't have enough exit from the market. So sometimes there were banks that were simply supported. All the banks were supported. Some remained in the market. and then they have still now a business model which is not sustainable, cost of equity, return on equity well below the cost of equity, no reasonable prospect going forward. So I think that, again, once you deal with this issue, you need also, and that's why I think that the European tool would be more appropriate. You need to really have conditionality on the restructuring and try to put strict conditions that the banks eventually are viable after the adjustments in the asset side is made.
If I just may add, maybe the voice of a skeptic a little bit here. I mean, the question that, and I don't have the answer. The question is, does the current version of the BRRD, is it fit for purpose if it comes to more widespread fragility? Can we use the tools, or do we need the tools outside the currently legal framework? That's my one question. My second question, of course, I mean, I think we all agree that we have to move towards away from these national silos banking system to a more European, at least Euro area banking system, or banking union banking system now. To which extent does politics stand in the way? And again, I'm looking at my own country and the government pushing the second and the biggest bank to basically merge with each other. I wonder whether this is another barrier which might have to be addressed and which stands in the way.
Andrea.
I definitely see the point. That's why, let's say, we submitted recently as ECB some comments to the Commission on the framework for crisis management that go exactly in this direction. So I think that the BRRD framework is all in all is a good framework, but might not be fit for purpose when you have these type of systemic events. And in these systemic events, it's also a recommendation from the IMF. Actually, you need to have specific tools in which you actually can depart in a predictable way from, let's say, the requirements of bail-in and the like, but with strong conditionality and strong restructuring capabilities. And the idea is that this should cover also, let's say, small and medium-sized banks that so far have been left totally under the responsibility of national liquidation procedures and national authorities, while instead they could have a quite a broad-ranging systemic impact also beyond their borders.
Loriana, can I just go to you for just a final comment, because we're more or less out of time on this, because there is a question from part of a question from Andrea, though, talking about whether the requesting additional capital to the banks with the portfolios more at risk, and recapitalization of banks is always one of the options here. But should we be rescuing banks or rescuing the borrowers from the banks?
Well, I think that, you know, we take already a position in our document. So we think that it is by rescuing let's say, the clients of the banks or the borrowers, you are also helping the banks indirectly. And, you know, and clearly this is issuing other, let's say, problem in terms of efficiency, but still, at least, you know, you are not continuing to provide incentive to bank to create to continue to lend to zombie firms and to, you know, to become zombie banks. The key question is exactly this, you know, when you are recapitalizing the banks with public money, what are then the incentives, and what are, it is always the same problem. What are the incentives that you are providing to banks to lend to someone else rather than continue to, you know, to postpone the recognition of non-performing loans? But of course, I'm not saying that it is a panacea to just help the borrowers, because even the borrowers, you know, we need to distinguish who are the ones that need to be just to support, because it is as householder, I think that we need to help householder after this crisis, as we are helping all the workers, and this is correct. But you know, we need really to look then to the business. What are the business models that are still working? Otherwise, we are generating a very perverse effect that in few years our GDP will not grow, and we will be not able to pay back, you know, the huge amount of debt that it has been built up so far.
Yeah. Well, thank you very much. We are out of time now, so we better finish this. Not least because I'm sure Andrea's got another meeting that he has to go to right now. I'm sure all three of you are pretty busy people, so thank you very much for taking the time today. Thank you to everyone for your questions and for coming along to the webinar. We hope we gave you what you want. Let us know, and so join us again very soon for our next webinar in this series. And meanwhile, stay safe. Keep watching the news. When we come back and do this same webinar next year, we might come to different conclusions, who knows? But I hope we'll be back to discuss this issue again. Meanwhile, from me, Tim Phillips at the CEPR, and from the guys at SAFE, goodbye and thank you.
Thank you.
Thank you.